Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, March 31st, 2023, and this is our monthly market monologue where we're going to talk a little bit about the stock and bond markets. We'll tell you what we're seeing there. We will also look at a few economic data points. As is our norm. Now, before going any further, I do want to call attention to the fact that once again, I've decided to sponsor a cycling team for the upcoming Victory Ride to Cure Cancer that is hosted by the V Foundation, or the Jimmy V Foundation. Now, for those of you that don't know, 100% of the proceeds that are raised for this ride or from this ride go directly to cancer researchers. None of the money that is raised for this ride goes to the V Foundation's overhead, which is one of the reasons why we do it. We do believe in trying to live generously, and cancer has obviously touched so many of our clients' lives directly and indirectly. So, and naturally, I love cycling, so this is one of the reasons why we've decided for the last couple of years to sponsor a team. I'm personally trying to raise $3,000 this year. Last year, I raised about $2,500, I think a little bit more than that. So if you have the means and you want to support our efforts to fund cancer researchers, most of which I believe goes to researchers right here in the Raleigh-Durham area, I will put the link to a secure donation site in the comments section below. So for those of you that do give, we certainly appreciate it. By no means is anyone obligated to give, but we do appreciate your efforts in that regard. The next thing that I want to mention is our client portal. I've been mentioning this in the last couple of market videos that I've been doing, and I was talking with a client yesterday, and they made a comment that they were on the portal, and I realized that they were actually been logging in to the TD Ameritrade site where our assets are custodied, but not actually our client portal. So if you go to our website, hicks-associates.com, if you click that client login button in the top right button, you're going to get to this page. And what we're really talking about is our portal, the H&A Wealth Management client portal. We do have an app. So if you have a smartphone, whether it's Android or Apple, if you search H&A Wealth MGMT, you will find our app in the App Store. So if you are a client of ours and you have not yet gained access to our client portal, feel free to reach out to Karen and we will help you get registered for our new upgraded site. One more housekeeping item is our investment policy statement, which we are going to be rolling out over the coming months. If you're a client of ours, you can expect to get this either shortly before or shortly after your next client appointment. And IPS is written with the intent of helping clients to understand how the advisor is actually managing money. Especially for us, when we use a multi-strategy investment approach, well, what does that mean? So this IPS was written in a manner to bring additional clarity to you, our clients, and to help you to understand or at least get answers to some of the most commonly asked questions regarding taxes and trade confirmations and internal costs of trades, etc. So far, everybody who has read this has commented that they really liked it. And we're pretty excited about it. So stay tuned to get your copy. If you have any questions, by all means, feel free to reach out to me or Braxton, our investment analyst. So that said, let's dive into some of the economic data and economic updates. In this month's market monologue, I'm not going to go into a ton of economic details simply because just a few days ago, I posted the full recording of the economic webinar that I gave to a local organization. That webinar is a full hour long. So it's got a ton of data. But the nice thing about YouTube is that you can hit the pause button, go eat your dinner, and then come back a day or two later and continue watching. So if you want a lot of economic detail, there is that posting for you on our YouTube channel. So in that webinar, because of March Madness, I used a scoreboard. So on the screen now is our scoreboard of some of the leading economic indicators that we walked through in that webinar. And you can see how many of them were suggesting a recession is coming, how many of them are suggesting that it's not necessarily recessionary, and then how many data points that we were looking at that were inconclusive. This scoreboard is as of March 22nd. But what we do want to do today is we want to provide an update on a couple of the data points and add one more. this is one data point that I did not go into in that webinar. And on the left scale, the green line here is the total non-farm payroll. And you can see that green line obviously corrected during the COVID correction, if you will, but it's at all-time high. So that is a very good indication. The blue line, however, is on the right scale. The blue line is the temporary help. And you can see that that has come in a little bit. And so when we are at risk of going into recession, one of the things that we will see is you'll see big corporations reducing their temporary staff. So you might have seen layoffs announced at Amazon. Well, that's not necessarily their executives. That's more likely to be their warehouse helpers or their temporary or their seasonal helpers. And so this is a little bit of a warning that corporations are trying to be a little cautious. And you can see the blue line dips a little bit before each of the last two recessions. So that is one warning sign that we didn't talk about in the webinar. And here's one that we did discuss, Dr. Copper. It's frequently said that Copper has a PhD in economics because copper prices typically go down leading into a recession. Well, one of the things that you saw on that scoreboard from just a minute ago is that copper was indeed indicating a recessionary environment. However, the latest update is copper prices have gone back up a little bit. So we now can put that back in the inconclusive category. One other data point that we talked about during the webinar was the financial conditions. And when this data series is above zero, in other words, that black line, when this data series is above zero, it is indicating tightening financial conditions, and leading into recession, financial conditions get tight. Well, during the webinar, the latest data point was still below that zero line, which was not a recessionary indication. However, I did mention in that webinar that we expected that to pop back up above this zero line, and indeed it has. So that's where we're at on the economics. Again, if you want any more detail, I would encourage you to watch that webinar. The full posting is on our YouTube channel. Switching gears now to the stock and bond markets. On the screen right now is our seasonality chart, where this is showing the average performance for the S&P 500 since 1950. Right now, as of about 9:45 in the morning, the market is trading up a little bit. And what it appears is that the month of March 2023 is going to come in above average. However, this chart makes it look like March was easy. That is certainly not the case. So here we have the monthly candle chart for the S&P 500, and I'm showing this for two reasons. One, I want to remind you that this line at the bottom of the white candle is where the market opened the month of March, and this is where the market is at right now, or as of yesterday's close. The wicks, the upper and lower wicks, are where the market traded. So we opened the month here, traded all the way down here, and it has rallied up to where we're at right now. And again, as of 9:45, the market is trading up about 0.5%. The other reason I want to show this monthly candle chart is it makes it really easy for us to see the importance of this 4,100 level on the S&P 500. It is certainly a psychological level, but this is the funny thing about technical analysis, is it seems odd that some random number would have some degree of importance, but it does. You can see it very clearly. So as of yesterday's close, the S&P 500 was about 1.2% away from this 4,100 level, and it is going to be very key, very telling if we can rally through this level, but instead of squatting back down, we actually hold above that level. So here we have the daily candle chart for the S&P 500 going back to the beginning of 2002. And a couple things to note. One is I'd like to highlight just a big sideways movement over the last 10 months where the market has just oscillated up and down, not really establishing a firm up or down trend. You can see the month of February was very negative. And the month of March started to rally, came in a little bit. This is where Silicon Valley Bank failed. And since then, the market has begun marching higher, but certainly a lot of volatility. Switching to the NASDAQ and back to a monthly candle chart, and we'll show this in just a minute. The NASDAQ has been much stronger, and you can see the difference on this monthly candle chart as opposed to the S&P 500, that it seems like the NASDAQ may have very well broken out above that range that it's been in. Looking at a daily candle chart, however, you can still see that, again, there's been this little bit of a sideways movement, but it's begin to reaching this point. If it can take out the highs from February 2nd, that would be a very encouraging sign for both tech investors as well as the broad market overall. However, one of the breadth measures that we like to pay attention to is something called the advanced decline lines. We're going to show you the advanced decline line for the New York Stock Exchange as well as the NASDAQ. As a reminder, the advanced decline line shows or plots all of the advancing stocks minus the declining stocks. And what we're looking for when we look at charts like this is we're looking for divergences. So for example, in the latter 2 months of 2021, we had the S&P 500 going up, but we had the advanced decline lines going down. That was a very big warning, one which we heeded. So here we have the advanced decline line for the New York Stock Exchange, and we are plotting that with the S&P 500. So what we're looking at the beginning of March is we saw the S&P 500 was beginning to advance, but the advanced decline line was not yet confirming. That is beginning to change. That is very good news. We also want to look at the advanced decline line for the NASDAQ. So now we have the NASDAQ on the bottom pane, and we have the advanced decline line on the top pane. And you can see, again, we see the NASDAQ is beginning to go up in March, but the advanced decline line was not yet confirming. That is beginning to change. However, we want to talk a little bit about why we saw the NASDAQ in such a strong rally, but not yet any confirmation in the advanced decline line, and we would say it's because of the big four. The big four that I'm referring to here are Microsoft, Apple, Google, and Meta. And want to take a quick second to highlight over on our blog. If you were to go to hicks-associates.com, at the moment it's the top blog post, but you can always find it by clicking the blog button. And it's this Why the Fed Raised Rates Amid Banking Crisis. We posted this on Monday. And one of the things that I pointed out in this article was right here. Within the S&P 500, regional bank stocks have been struggling, falling 34% year to date. Broader financial sectors declined 9%. Meanwhile, S&P has gained around 3%. That was earlier this week. However, the technology sector was up 17.5% as of this date, and the communications sector was up 18.4%. But what we're trying to highlight is that the fact that Microsoft and Apple make up almost 47% of the technology sector ETF, while Meta or Facebook and Google make up about 47% of the communications services sector. So while the market might very well be moving up, while it looks like the NASDAQ is moving up, what we're finding is that these four stocks, Microsoft, Apple, Google, and Meta, are pulling the bulk. So it's like you have one really strong dog pulling all of the weight on that sled team, or one horse on a sled team is doing the majority of the work. That's what we have been seeing. So if we look at these big four and we take a equal weight index of them, which is what I was just showing you, and now we're going to compare that to the S&P 500, you can see that an equal weight index of those four big stocks is up year to date about 29%, whereas as of yesterday, the S&P 500 is up about 5%. The point that I'm trying to make is that when you have a small group of stocks, in this example, it's only four. When you have such a small sampling of stocks that are doing all of the heavy lifting of the index's return, it is deceptive. we get the sense that the indexes are being repaired and the indexes are recovering. But when you look beneath the surface, it's really just a handful of stocks. That is not the sign of a healthy market. And this is what we were highlighting at the end of 2021 when we saw the S&P 500 going up in large part because of this same group of stocks. But the advanced decline line was going down. And part of the reason this happens sometimes is because the big institutions, the mutual fund managers that are managing billions and billions of dollars, they will sometimes hide in these big stocks because they're usually forced to be fully invested. And so they end up moving assets into these really big liquid names, and that pushes a handful of these names up. But the overall stock market is showing signs of weakness. So when we see it happening again, yes, we're encouraged that the overall market appears to be going up, but we got to look underneath the surface. That's why we pay attention to this. So just a couple more slides and we'll land the plane. That said, please don't forget to subscribe to our channel if you haven't already. On the screen is the participation. It is another one of these breadth measures that we are paying attention to, and you can see that the percent of stocks that are above the 200-day moving average is back above 50%. So that is good news. Still a little bit of weakness here, but overall these measures are indeed improving. That is good news. However, now we have small caps. If the markets are going to move higher, it's unlikely to do it without the small caps participating. And right now we have not seen the small caps recover. So that is definitely one of the warning signs. Here we have on the screen the S&P 500 is the red line, the NASDAQ is the blue line, and then we have long-term bonds is the green line. For the month of March, the high degree of correlation between stocks and bonds has continued. So this is our last chart. It is the chart for TLT, the iShares 20-year Treasury Bond ETF. And what I'm trying to highlight here is that in October, we had the low so far for the stock market. That was also the low for bonds. Bonds began to rally into the end of the year, but since then, they have really moved sideways into a sideways channel. If we can break out above this black line, that would be very encouraging and would help those traditionally more conservative investors. Hope you have found our monthly market monologue to be helpful. Again, we encourage you to hit the subscribe button on YouTube as well as hitting the like button, leaving us a comment. We love that stuff. And again, we thank you for watching. If you have any questions, by all means, feel free to reach out to me or my team. We do serve clients all across the country in today's digital age. And we'll talk to you soon. Thank you.